everyone. Glad that you can join us. And so we are here today to learn about financial forecasting with KongBasileConsulting. And so we're super excited. We're here with Matt Tyler, Sunita Kumar, and Stan Khan, their founder. And so I'm going to go ahead and pass it on to Stan to tell you a little bit more about their consulting firm, and also stay tuned in the chat to see how you can reach out for a one-on-one consulting opportunity.
Thank you, Tiffany. Hello, everyone. My name is Stan Kong, one of the partners at KongBasile. I want to thank you all for attending and want to welcome all of you. I hope everyone's doing well and surviving during these really crazy times. We appreciate this partnership with the VGV community. And again, thank you to Tiffany and Shelley for this opportunity. I just wanted to provide a quick introduction. We are a boutique finance and accounting outsource and consulting firm primarily based in the Bay Area. However, we have team members in Southern California, Austin, Texas, Seattle, Washington, Honolulu, Hawaii, and Matt's in Mexico City. Our focus and client base are early stage growth companies, primarily in technology, but growing number of clients in non-tech industries. I would say approximately 85% tech and then 15% non-tech. We've been in business approximately 7 years and have 80 plus team members as of today. Our expertise is in finance and accounting operations and helping our clients grow and scale while also meeting their finance and accounting requirements. We essentially provide services from basic bookkeeping all the way up to CFO level services and everything in between. So today we are excited. The team is going to help tackle one of the most important finance skills to managing your business. That's developing a forecast. My colleagues, Matt Tyler and Sunita Kumar, the presenters today, they have a tremendous amount of experience and great experience. I will turn it over to them to introduce themselves. And they'll jump right into the training today. So thank you all for joining us. Matt and Sunita, I'll turn it over to you.
Great, thanks, Stan. Hi, everyone. My name is Sunita. I've been with KongBasile for about 2 years now and have about 12 years of finance and accounting experience overall. Most recently, before KongBasile, I was with One Medical and Eventbrite, kind of helping them through their growth trajectories. And I'll let Matt go ahead and introduce himself.
Hi everyone, thanks for having me. Very excited to be here with what is a very worthwhile initiative. I've been with KongBasile for 18 months now. Prior to that, I was CFO of a software firm out of Austin, Texas, with about 100 million of revenue. And prior to that, I worked in restructuring for a dozen years or so in the UK, where I'm originally from, as you may be able to tell by my accent, and Australia as well. And as Stan mentioned, I now live in Mexico City. Thanks very much.
Great, so I'll go ahead and share my screen, and we can kind of jump right into our right into the presentation. So today we'll be talking about building a 3-statement forecast model, a brief agenda. We're going to start with an overview of a 3-statement forecast model, different types of models we usually see at our clients, some of the main benefits and ways our clients use forecast models, and some definitions. Then we'll go into some more detail in terms of building out detailed financial statements. So I'll kind of start with the P&L, briefly go over a balance sheet forecast, and then Matt will dive into how to think about forecasting cash flow, both in kind of focusing more on a short-term time frame. And then we'll leave some time at the end for Q&A from the everyone attending. So kind of overview of a three-statement model. Some of the main uses we see are kind of helping with decision-making. So anticipating the impact of any changes in strategy, any pricing changes, any new product lines that come through, new expenses that are anticipated, really understanding the financial impact of those types of things. Risk management is a big one, identifying any financial risks, also operational risks can be really important and can kind of come through review of a financial model. Driving results and accountability, often sharing, kind of producing a forecast model, sharing goals and plans with employees, helps employees and team leaders think through how their operational activities will impact the business. And when companies are ready, even starting to drive some accountability from team leaders using a forecast model. And then, of course, kind of external stakeholders are always looking at forecast models to understand their investment in a company, understanding the business model. It's a quick way for them to gain an overview of how the business model works. I have on this slide just some example analysis and insights that we usually go through using a forecast model with our clients. So scenario analysis is a very common one, especially in this environment. We want to be able to understand the upper and lower bounds of a company's financial position in different scenarios. So what are some of the orders of magnitude with potential declines in revenue growth, potential upsides in revenue growth that can help kind of plan for the future. Annual planning, when we get into detailed annual planning cycles, a good baseline to start to look at an annual plan is to look at kind of the last quarter of the current year and multiply that by 4. And then layer in kind of any growth objectives, any planned revenue increases, and in the same way, any efficiency objectives, any kind of cost savings measures that might come through in the following year. And the final one, equity valuation. Again, external stakeholders are always kind of looking at their investment in the business and does it make sense in terms of the business model. So some definitions, you may already be very familiar with these, but thought I'd briefly run through kind of definitions of each of the financial statements. Profit and loss statement, also referred to as the P&L or income statement. This is a snapshot of a business's ability to generate an operating profit. So within a certain period of time, how much money is received, how much money is spent, kind of the operating activity within any given month or quarter. A balance sheet reports what the company owns and what it owes at any given fixed point in time. So assets are things like your bank balances, any large CapEx purchases. Liabilities could be any outstanding loans, any outstanding payables owed to companies, things like that. And then a cash flow statement kind of derives from the previous two statements and reports the company's cash activity, the cash inflows and outflows every year. Types of models that we usually see, this is kind of generally what we see. Usually see kind of the first type is a long range, very high level model. And this is usually, an initial business model that you may come up with, kind of high level assumptions, a longer time frame, generally about 3 to 5 years, focused on kind of your overall strategic goals. So you'll, want to see in this type of model, margin improvements, some sort of path to profitability, if that's relevant, those types of things. A budget and a forecast is then kind of derived from a long range plan and is generally shorter term. It's about 1 to 2 years. This is where the detailed budgeting and investment allocation decisions are made. You know, and when a company is at a point where they want to start to disseminate detailed budgets, this is where budgets are created and can help drive accountability within a company. So for purposes of this presentation, we're going to focus on the second model, the more detailed model, that we can sprinkle in any kind of insights or things we've seen in a long-range plan as well. So setting up, kind of diving into the mechanics of setting up a model, kind of initial things you want to think about are the purpose of the forecast, who will be using it, will it be for investors, will it be for kind of team leaders within the company, the time horizon of the forecast. You know, in a very detailed model, you'll probably want to build kind of a monthly time frame. And then making the model as dynamic and flexible as possible. So kind of trying to avoid hard coding where you can, trying to automate where assumptions flow into the model can really help with kind of long-term ease of use of the model. And then I have an example structure here, but kind of generally you want to see kind of your 3-statement forecasts, any very detailed forecasts that you'd like to build, a headcount forecast, a revenue forecast, usually like to see those on separate tabs. And then some way to input actuals into your forecast so you can start to compare against results. So this could be actuals from an accounting system, this could be KPIs, things like that. Building in some way to quickly update the model on a regular basis. Diving into the P&L, this is kind of just a very generic P&L. This will look different, obviously, based on the type of company, but kind of first want to understand revenue and kind of cost of revenue, and build out some way to think about gross profit modeling. On the expense side, you want to start to bucket expenses and build an expense forecast based on the drivers in each category of expense. Revenue gross profit modeling, this will, again, obviously vary by company type, but we usually see this as kind of either a high level year-over-year growth in revenue, driver-based revenue models, so building revenue models based on sales price, number of customers, number of contracts, things like that. In a more enterprise-focused company, you may see a build based on sales quotas. And then modeling cost of revenue, or COGS. Generally like to think about this in terms of fixed versus variable cost. So fixed costs in a typical software company might be hosting costs that don't increase directly in line with revenue. Variable costs might be credit card fees or merchant fees. So ensuring as you're building your revenue, you're kind of also building in any cost assumptions that are important. And then once you have those built, you can start to think through decisions you can make based on the model you have, or analysis you can do. So what levers can the business use to pull to grow revenue? So that could be things like increasing sales price, increasing sales and marketing initiatives, things like that. How can you improve gross profit over time? Looking at cost efficiencies, looking at if you are able to see margin based on product, how can you change product mix? And then also thinking through what are some of the risks to your revenue outlook. So this could be retaining employees, this could be market risk, things like that. Just understanding where risks within your entire gross margin lie. So that's kind of an overview of revenue gross profit modeling. I think there's a lot more we can go into here. So looking forward to any questions you have in the Q&A. Moving on to expense planning. With expense planning, we usually start with with payroll, just because for most companies, that's kind of a heavy expense that involves a lot of decision making. And so there's a few ways to think about expense planning. There's one option is to build a detailed headcount plan by employee. And this will enable you to quickly add new hires that you plan to have, change salaries, play with start dates. If you want to hire 10 new people in the coming year, you can look at the impact if they all start at the beginning of the year, if you space them out throughout the year. Another way to do headcount expense planning is ratio-based modeling. So kind of where headcount is needed to support growth. One example we commonly see is the customer support labor model. So number of incoming calls from customers require a certain level of customer reps to support them. So we look at those ratios, calls per customer rep. Usually in a customer support labor model, you'll have a management layer. So we look at the ratio of customer reps to manager, and then you can start to build out an FTE model from there and build out an expense model. This can apply across a range of industries. It can apply to sales teams, it can apply to retail, to new stores, to restaurants, to kind of kitchen staff versus kind of front of house. So we kind of commonly see those in those areas. And then other expenses, just very high level. These are kind of the main types of expenses we see. Headcount-driven expenses. You want to make sure you are forecasting employee taxes and benefits. This usually adds another 12 to 20% on top of your payroll expense. Other things are travel, recruiting, HR, and computer equipment, all of those little things that come with hiring an additional employee. Contractual commitments. These are generally things like office leases, kind of long-term annual subscriptions. So a model can help you build, can help you see those expenses and build in pricing and price increases and understand the impact of those types of things. And then sales and marketing. One way to think through this is to understand the investment in sales marketing in relation to new customers. Is the amount that you're spending in this area per new customer, and usually we call that CAC, or cost of acquisition. Does that make sense for the business? And just some things to think about when forecasting OpEx. Understanding expenses as a percentage of revenue. As your company grows, maybe initially you're investing a lot more in product, and then as you start to sell your product, you're investing more in sales and marketing. And do those expenses as a percentage of revenue make sense? Do your expenses align with your long-term growth model? Are they palatable in terms of where you see your company growing? And then kind of comparing your results and continuing to refine your expense forecast over time is also really important to kind of help you be able to predict your coming months. So kind of jumping into the balance sheet, I'll just go over this briefly. But kind of main things that we think about when building a balance sheet are really a lot of these assumptions are driving a cash flow model, which Matt will go into more detail on. But a couple things to point out here: accounts receivable, understanding accounts receivable and accounts payable is important to understanding kind of short-term cash cycles. So when are customer payments that are owed to the company coming in? When are you paying vendors? Does that cash cycle make sense for your short-term kind of cash needs? A couple other areas we see on the balance sheet are fixed assets, large CapEx spends. These could include things like computer equipment, office remodels, those types of things. And then also kind of reflecting any debt equity arrangements, so loans, funding that you have or that you expect to come in can kind of help you understand kind of cash flow on those arrangements. So I'll go ahead and turn it over now to Matt to go through the cash flow.
Thanks very much, Sunita. Let me just share my screen so you can see the presentation where we're picking up from. So moving now on to cash flow. Here we have a range of questions that you may have asked yourself at one time or another, or may ask yourself in the future. And all of these questions here can be answered via a cash flow model. You know, it can range from the very basic, but very important, do we run out of cash this month, to questions around how many more staff can we hire, and can we have new offices, and things like that. So it gives you a good range of things to think about, which are all going to be answered via cash flow reports. So what do we use to forecast cash flow? And the reality is it depends on the purpose. So working from right to left here, on the right we have a long-range plan, and this ties into what Sunita's talking about. This is, you know, high level, big picture. It's more strategic, and it's thinking about where you want to be in the next 3 to 5 years. The downside with a plan like that is that it doesn't necessarily have much granularity, and it doesn't tell you what's happening in between or within these periods. So if your model is every quarter, then you don't know what's happening week to week. We then move across to budgeting and forecasts, which are 12 to 18 months to 24 months. They have more granularity and detail, but they can still be quite complex to build, and often need some finance experience. And so if you don't have that kind of experience, and you don't have the financing to be able to bring in a CPA to help you, what can you do? My recommendation would be to start with a short-term cash flow. And this is very similar to what we do as individuals within our household. You know, you look at how much cash you have coming in this month, you look at what your expenses are. You think about, hey, you know, when do I have big one-off expenses like house insurance or car insurance or school fees, things like that, and you try and build them all into your model. And when you're looking at short-term cash flow forecasting and determining what your cash runway is, which is how much cash you have, or how long you have until your cash is going to run out. There are two main ways of doing that. The first one is kind of a quick and dirty method, which looks at how much cash you've spent each month, averaged over, say, the last 3 months, 5 months, depending upon your business. And you look at your total cash available, and you say, right, if I have $1,000 available and I spend $200 a month, then I have 5 months cash runway. And that gives you an idea of how long you have left. But that doesn't really take into account any changes that you might see in the future of your business. You might say, well, you know, yes, I've been burning $200 a month for the last few months, but actually I have new business opportunities coming in, so I don't think that's accurate. So then we would suggest that you move on to a cash flow forecast, in which you're modeling your cash inflows, your receipts, and your cash outflows, your payments. And you can do that on a weekly basis or a monthly basis. It takes a little bit more time to prepare it, but it's a lot more accurate. So how would you go about building one of these cash flows? And generally we would say, try and set it up logically, think about the broad sections that you're going to need. Bear with me. here we go. So your cash inflows, what do they look like? So depending upon your type of business, you might have customers who pay you the same amount every month. And we generally, in software, we think of those as a kind of subscription type revenue. You know, if you're a writer and you're selling a newsletter, you might have subscribers who pay you $10 every month, right? So factor in those, say, how many do I have now? How many will I have in the future? At $10 a month, how many is that? How much cash is that going to give me? Then you might have bigger one-off projects that you do that you've invoiced for, and you might say, right, I've invoiced one customer and I know they're going to pay me in 30 days, so I can put that money coming in 30 days time. I also know that I'm going to have another project finished in 2 months time and they'll pay me 30 days after that. So you can build that in. And that's factoring in new sales as well. Then there might be other receipts. You know, there might be some kind of government funding that you get. You might win some prizes. You might have cash coming in for investments. People investing in your business. So you can look at all of that money coming in. Then you look at your cash going out. So generally speaking, we'd look at a few big buckets for that. You say payroll. How much do I pay myself? How much am I going to pay people who work for me? Rent. Do I rent a property, an office, particular hardware? How much do I pay for that and when? Suppliers. What consumables do I need to buy? How much does that cost me? When do I pay those? Credit cards. And with a credit card, you don't look at when you incur the expense, you look at when you pay off your credit card. That's when the cash leaves your account, and that's when you factor that in. Do I have any loans or interest? Am I repaying the loans? Am I just paying interest? And then last of all, we'd have a bucket called other, which is really designed to kind of capture everything that sits in there. If I just roll it back one slide, the longer term cash flow forecasting here derives from the profit and loss and the balance sheet, which Sunita talked about earlier. This is more of a kind of technical setup that I'm not going to go into detail here. But really what you're saying there is, what is my profit in a particular period? And then you adjust that for things like working capital. And what do we mean by working capital? Working capital is how much money you owe other people and how much other people owe you. And then you have your financing and investing. What do we mean by that? That's equity. Are people investing in your business? Are you putting more money into your business? Are you buying fixed assets? This could be office furniture. It could be computers. How much are you spending on that? And then one of the other buckets here is debt. So can you get a loan from a bank or another group? When do you have to repay that? What are your interest requirements, etc.? So next I'm going to show you what it should roughly look like. And this is an example that we have used on a prior client that we've cleaned and taken out any sensitive information, but it gives you an example of how it looks and how it should work. The key thing to note here is that this section in blue over here, this one here, these are what are called actuals. So we built this model to reconcile to bank statements each week. So at the beginning, when we first started building that, we said, right, how much cash do we have in the bank? And you should be able to see this down the bottom here. And then during the week, how much cash came in, which we can see in the bank, which is up here, and then how much cash went out, which we can see here. So in this particular week, we had net cash flow of 34,000. So our opening cash flow plus our 34,000 net gives us our closing balance here. When we talk about setting something like this out logically, I think it's important at the top to have clear labeling, which shows you what are the relevant weeks, what are the start dates, what are the end dates. So as you go through, you can see, right, when's the end of the month, when's the 15th, in which week would I, say, for example, pay my credit card. Then after that, we have our cash receipts. So this is money coming into your business. And as talked about, you'd look at things that you've already invoiced. You'd look at new invoices that you think you're going to issue, new sales. Generally speaking, I would suggest separating new business from existing business, because new business is inherently more risky and more uncertain, whereas existing business is a little bit more understandable and easier to forecast. We talked about other income. So you may have sublease income if you rent out a space. You may have funds coming in from the government. You may have tax refunds. You may have partner arrangements where people are paying you a percentage. You'd look to factor all of those in as well. And the aim is that, each week you should be able to say roughly how much money we think we're going to see. If we take an example here, this line here, we work this on a daily average. We said roughly each day, our client gets about $6,500 deposited into their bank. So each week that's going to be roughly 45,000. And you can see that this number varied over time, 50, 49, 61, 38, 40, 43, but it was pretty close to our forecast, which allowed us to have an idea of what our cash inflows were going to be. If we move on to cash payments, I think it makes sense to split this out by type. So look at how much you're paying in payroll. As I said, that could be paying yourself from your business or paying other people from your business. Do you pay these people once a month? Do you pay them twice a month? Do you pay them every 2 weeks? And this gives you a different kind of cycle of when your cash goes out. You can look at your benefits and healthcare, if there's any of that in there. You could look at rent. How much rent do you pay? When do you pay it? Do you have any free rent periods provided from your landlord? Your utilities and your common area maintenance, these additional costs, or are they captured within your rent charge? Then suppliers, and you can split this out into separate categories or look at it in total. Within your suppliers, how much are you paying for paper, office supplies, consumables? How much are you paying for the purchase of raw materials for what you're creating and selling? And sometimes these are estimated, but I would say start off with an estimate. Write it down, see what it looks like, and then refine it over time. Don't be afraid to start something because you don't think it will be accurate to begin with. As you go through building something like this, you understand your business flows a lot better, and your modeling, your forecasting will get better and better over time. The other categories we talked about: credit cards, loans and interest, and then an option for any manual adjustments. If you generally pay your rent in the first week of the month, but the next month you're actually paying it in the second week, we can adjust for that. Then down at the bottom here, this is your cash summary. What do we have? So you have your opening balance. How much cash did you have at the beginning of the week? Then you have your cash in, which pulls from the top up here, your cash payments, which pulls from here, and then your closing amount. And the kind of important thing here is to balance your accounts. Make sure that what you're showing as your closing balance matches to your bank statement. That way you know that your capturing all of the cash inflows and all of the cash outflows in your model. And then as you build this up over time, you can see that there are patterns to how your money comes in and how your money goes out. And you can start forecasting based upon those patterns. That gives you an ability to get more accurate over time. So how is the best way to record your actuals in a model like this? So the first thing is download your bank statement transactions. Every online banking option or portal has an option for this, so you can download them. Then I would suggest you're best off categorizing your expenditure into broad types. So as we saw on the prior slides, you say, this is my rent, these are my payroll costs, these are my supplier costs. And then you can update your model each week with your actuals from the prior week. You can get into a pattern of doing that first thing on a Monday morning. It shouldn't take very long to update. And then you can look back and say, how did I do? How accurate was my forecast? What happened last week? Do I need to make any changes going forward? So next, we're going to move on to a few tips around how to build this. I don't know what your level of kind of Excel or Google Sheets proficiency is, but try and keep your formulas simple and keep them consistent. We haven't provided examples of how these formulas work, but we're offering sessions with people to reach out with any questions they have. We'd be more than happy to kind of give you examples of how to do this. And the internet is an amazing resource for how to build things in Excel. So feel free to reach out or have a look online. Secondly, look to obtain your information from original sources and reports. If you can download something from an accounting system that you use, or a sales system, or something like that, do so and just paste it in. That means it's going to be quicker to update your model each time. You want to be able to see what has changed from week to week. Last week we thought we would have $25,000 worth of cash at the end of the week, but actually we had 35. That's a massive improvement. But why was that the case? Is it because we didn't pay people? Is it because we got more cash in than we thought? As I mentioned before, focus on simplicity to begin with. Just get something down on paper. It's similar to what people say to writers or anyone else trying to develop an idea. Get something down and then look to refine it later. You can become more accurate as you understand what you're doing and building it over time. Focus on your initial weeks. It's very easy, or it's significantly more easy to say, who's going to pay me next week and who am I going to pay next week, than it is to say, who's going to pay me and who am I going to pay in 10 weeks time. Focus on the near term, and then with time you will become more and more accurate and have more confidence in your numbers further out. Think about things like annual payments, insurance, these one-off expenses that come around. They're the things that usually get missed because they're not regular, they're not based on a pattern. So look to build those in and making sure you're not forgetting them. So then we come to the question of what happens if you're forecasting that you're going to run out of cash. First of all, I say don't panic. Businesses see this quite frequently, and I'm sure a lot of businesses have seen it far more frequently this year with the changes around COVID. To be able to avoid failure, You need to know how much cash you need to solve the problem and when it's going to happen. Information is power. If you know what is likely to happen in the future, you can develop a plan to fix it. So what are some of the options available to you to be able to kind of mitigate this or avoid completely the situation? And I would break those down into three groups. So firstly is a new source of cash. Can you get money from shareholders? Can you get a loan from a bank? Can you have cash coming into your business to fix the problem? Secondly, and this is more operational, can I get my customers to pay me sooner? And the reality is, I think there are two main ways of being able to do that. One is early payment discounts, and we've all seen that. People say, if you pay up front, I'll give you a 5% discount. And secondly, chasing your customers more. This is more intensive work for you to be able to call up your customers and say, hey, you haven't paid your invoice. When are you going to pay it? But that hassle generally means people will pay you a bit sooner. And then thirdly, another operating point is, what can I do to avoid paying some of the payments that I think I have to make now? What can I do to push them out? And if you have a loan, you might say, can I just pay you the interest and not the principal? If you're renting a property, you might say to them, hey, can I not pay you next month's rent and pay it to you in 3 months' time? You might look to say to your staff or to you, can we take a pay cut? Can we defer our salary? So rather than taking it now, we'll take it in a month's time. And finally, negotiating with suppliers, where you say, I'm struggling on cash. Can I pay you later? Is there a payment plan that we can come up with? These latter two are the salary cuts and the negotiation with suppliers. They're a bit more high risk because you're telling people that your business is having problems. So I would suggest that they are more of a last resort. Focus on getting more cash in if you can, and then looking to push out payments where possible. And the reality is, if you have this information, then you can avoid failure. It may be pretty close, it may be touch and go, but using a short-term cash flow really helps with that. And I think to kind of summarize that, I'd just like to show you this little meme that a colleague of mine built for me, which visualizes the use of a short-term cash flow in startups. Thank you, everyone. I think we'll open up to Q&A now. Tiffany, shall I hand back to you to moderate that?
Yes, awesome. So thank you so much. This was super, super informative. I know everybody's pumped and there's so many questions because it's such a great topic and it's something that every founder needs. So let's jump right into a few of them that I see now. So one question that people had was they wanted to know if you had like a template or like a place, a resource online where they might get templates for basic spreadsheets around some of the different ideas that you guys presented. Is there any places you guys go to for those types of resources?
That's a good question. I don't think that KongBasile has a repository of templates available, but I know I have seen online, and there are a number of websites that do share this type of thing. I would just suggest, be careful about what you download. You don't want to download viruses, etc.
Right.
And in my experience, looking at someone's template and then trying to build it yourself gives you a much better understanding of what's going on than trying to fill in the gaps on a generic template that won't be designed for your particular business.
Great.
It's the balance between something bespoke that works for you versus something generic that works kind of 80% for everyone, right?
Great. Yeah, I love that advice. And I totally agree. I think, it can be good guidance sometimes if you have templates or, maybe your company has different OPAs that they use, or like you said, online, it can give guidance to somebody who's unfamiliar. But I think at the end of the day, it's great advice that it's better to really try to build your own once you're informed, so that you have things that are more specific to your company and the things that you are delivering. So that's awesome. All right, next question. So in regards to QuickBooks, they want to know, does QuickBooks platform support building out any of your financial models, or is it strictly bookkeeping, or do they have any sort of additional features that we might not be aware of that could be cool to use?
So QuickBooks is great as kind of an initial step in kind of bookkeeping and getting your financials together. They do have an add-on called Fathom, which is more of it's a reporting add-on. I think it's doing some very light forecasting, but at least kind of can give you reports and cuts of your financials in different ways, and able you to model those into Excel.
Could you say the name of that one more time?
Yes, it's Fathom. I'll type it into the chat box.
Fathom, awesome. Nice.
And just for some background, Fathom requires additional fees, if I'm not mistaken, on top of the QuickBooks.
Awesome, good to know. And so another question we have is, or somewhat of a question, if you could give us some insights on building good relationships with a CPA, or if you are looking for a CPA, if you have some capital to put into that, what are some things that you would look for to make sure that you're, vetting the right person, and the rates that would probably be best?
I'll take this one first. I'll let the others. So first, I want to clarify between a CPA and an accounting firm that does work like this, like forecasting. Not all CPAs, a lot of CPAs are tax focused only. So I did want to clarify. I think there's some questions like, I need some help with finance forecasts. Will my CPA help me? Some will, some may not. Some are just strictly focused on tax. So the first thing I would say is to identify a finance professional that does this, number one. And then the question is, what do you look for? I think it's someone that really will listen and understand your business, as Matt and Sunita have mentioned in this presentation a few times. Everybody's business is different. everybody's goals for their business are different. So I think and then everyone's, their relationships that are relying on this forecast are different. So it's very important that whoever you have helping you or you want to help really is listening to sort of those three needs and can help take those and build it or guide you into building that model. So if you run into someone that says, I know everything about your business, I can build a model, it's probably not a good fit, is my simple guidance.
Nice. Thank you very much, Dan. That's really, really good advice.
The other thing, sorry, Tiffany, if I could just kind of tag something on the end of that. The other thing I would say is with any type of professional service you get, whether accounting, consulting, marketing, building, you can have it cheap, you can have it fast, and you can have it done well. And you can generally only choose two of those three options. So decide what you need and plan accordingly. What is done well and done quickly probably isn't going to be cheap. What is cheap and done well probably isn't going to come to you quickly.
Awesome, great advice as well. And I think that's true. You're right across the board. So we love that. And I think one more question that we had was, I guess with the current, change in the landscape, of course, due to COVID and so many other things that are going on in our nation, why do you think a lot of the companies are struggling? And do you think a lack of financial forecasting, do you think that has anything to do with it? Or do you think that maybe these types of variables are too steep to be something that can be really forecasted?
Wow, I'll start again. That's quite a question, a really excellent question. So number one, to address why some have not been successful, I think it's such a surreal and unprecedented event that many, if not all of us, have not seen in our lifetime. So it has affected, and then just the shutdown, right? The pure nature of shutting down has caused obviously a lot of business to go, and then there's a downflow from that. When there's shut down, then there's businesses that rely on it. So I think that's one part. Now, the question of would a forecast have helped? Honestly, I think some. And the reason I say that is we sort of went through a high level of what a forecast and how to develop a forecast. But once in terms of more sophisticated forecasts they always include the optimistic view, the realistic view, and the cold winter day, right? So the worst case scenario. And I think maybe more sophisticated business owners, maybe a little more conservative, will have that winter day. And then from that winter day, they will know the steps they need to take in terms of what do they need to save on? Do they need to let people go? And then those that develop a forecast but don't really focus on that part and just look at the optimistic sunny day, they're probably in for a big surprise. And similar to Matt's little meme there, hitting the trees, whereas the ones with the winter will hit the trees and then sort of take off a little bit and hang out safely. So in essence, I do think that more sophisticated, conservative views included with your forecast can certainly help.
Awesome. Thank you so much for tackling that question so well. You guys have been outstanding. This has been super phenomenal. And again, the replays and any other information and slides that they can share will be available to you guys after this. They'll also be available at www.bgvconnect.com. And I don't see any more questions right now. So I think if you guys do think of questions, which I'm sure you will, please go ahead and copy this email. I'm dropping in the chat now, ask.us@KongBasile.com, and reach out to these friendly, wonderful people who have so much knowledge to share about finance and can definitely help support your business. Thanks, guys.
Thank you again. Take care.
Bye.
Thank you, everyone.